All right, I think we're going to start the webinar now. We might have more people joining us in a little bit. So, good morning, good afternoon, and good evening, everyone. Thank you for joining us for this Impact webinar, Saying Yes to Opportunities, Building the New SAF Powerhouse. My name is Linda, content producer at Leader Associates, and I am your host today. So, today's session is sort of a prelude to our upcoming SAF APAC Summit taking place in Melbourne this July. So that's next month, where you'll be joined by 500 plus industry experts from all these industry leaders, such as the Australian government, Thailand government, Qantas, Air New Zealand, FedEx, and many, many others. So today's discussion sort of lays the groundwork for the advanced sessions you will experience there, and we highly encourage you to secure your spot soon. So let's take a quick look at today's agenda. So we have some keynote presentations. We'll begin with insights from our 5 keynote speakers, and then we'll move on to a conversation featuring a separate group of industry experts. And it's lovely to have you all here. Thank you all for sharing your insights with us today. I would like to encourage everyone to stay till the end, of course, but please do take breaks in between and come back for your favorite session. We will take Q&A throughout the sessions, so please type them into the chat box or in the Q&A box. And as we can all see, the APAC region is moving way past the initial market hype and headed for real action. We can observe all kinds of active pilot programs, genuine cross-sector partnerships, and infrastructure projects taking off. APAC is it's not simply catching up, but it's actually shaping the future. Our keynotes today will start with a market overview, and then we'll highlight the actual projects and development driving this momentum. And then our panel discussion will build on that foundation to explore the future of this market. So with that being said, I'm going to stop yapping and welcome our first speaker, Alfonso Berrocal. He is the Vice President of Oil Products and Biofuels at Argus Media. With an extensive background in physical trading, he oversees refined products and sustainable aviation fuel markets. So today he's going to deliver our opening presentation. Alfonso?
Thank you, Linda, for the intro, and good day, everyone, and thank you for joining this session. I'm gonna hopefully share my slides. Let's see.
Okay.
Can you see my slides?
Yes.
Right, fantastic. So thank you for joining this session, which we have named Closing the SAF Gap, Keys to a Maturing and Resilient SAF Market. My name is Alfonso Berrocal. I'm Vice President of Oil Products and Biofuels, and I'm sitting here in Singapore for Argus. So the agenda of this session, we will first talk about production capacity and demand, and how the gap between them is closing. We will touch upon alcohol to jet as an alternative to HEFA production, and as well we will dig into SAF prices versus jet fuel prices, and then we will touch upon very briefly as well on the role of carbon pricing, and then finally we will wrap up with the conclusions. In this bar graph, you can see the global HEFA capacity by region versus the demand, the global demand, which is that red line. As you can see, the different regions are highlighted in a color, and then the gray color is for that production capacity that it has been announced, but it has not reached FID. And actually, there are a lot of projects which they are announced, but finally do not reach FID. So you will need to take that production capacity as very provisional. So it's worth to focus for this exercise just in the capacity which is colored. And as you can see, the first thing is that it is obvious that there's much more HEFA capacity than demand, which put us today in a long market from that perspective. And actually, looking at the graph, seems like the market will not be balanced till 2034, 2035. Okay. However, when there's another point that we need to take in consideration is actually that the production capacity remains flat between 2030 and 2035. However, the demand continues growing. What is driving demand? And I think it's fair to say that the European Union SAF mandate and the UK SAF mandate are the global drivers of demand. And it's as well fair to say that without them, probably we will not have the SAF market that we have today in place. The European Union mandate started in 2025 with a 2% blending ratio, which will remain flat till 2030. And actually, there's been some criticism about that 2% flat because it hasn't really incentivized more liquidity and more capacity to grow, to enter into the market into the short term. But definitely it's very ambitious in the long term with that 6% in 2030 growing, escalated up to 70% in 2050. But at this point, I think we need to focus in 2030 and 2035. We saw the previous graph, 2035, that was the point of where demand outpaces capacity. And by then, the European Union has a very ambitious target of 20%. The UK mandate, which is as well driving quite a lot of demand, it started as well with 2%, but it grows every year. So it's more ambitious in the short term. And it's 10% GHG saving emissions, okay, by 2030, and 15% GHG saving emissions by 2035. So in 2035, we have a big component of demand taking place in Europe. Now, when we look at firm demand, we can only compute that demand which is mandated. So the next focal point is Asia, really, because the US is an incentive, is incentivized demand, which is a very fair way to approach it, but it's very difficult to foresee and to make it firm. Yeah. So, however, in Asia, there's already 3 countries that we compute on that, which are Thailand, Singapore, and South Korea. They seem ready to start consuming molecules. 2027, there's been already some cargoes, some tests going on in the 3 places. The government is very, very keen to move forward. And there is another number of countries in Asia which is still is not firm demand because those mandates are not confirmed, or those targets. But definitely, as we move forward, it could be a game changer if all these countries start consuming SAF. And I wanted to highlight here Japan in 2030, 10% blended ratio or 5% GHG saving emissions. India with 1% obviously will be quite instrumental. Indonesia, Malaysia, they are already looking as well, maybe towards 2027, 2028. And obviously, everybody's talking about, will there be a mandate in China? Well, if there was, that will be definitely a game changer because it's the biggest producer of HEFA and the biggest producer of UCO. But at this stage, we don't know. The message here is that in that demand, there is an upside for much more growth that it could take place within the next 2 to 3 years. Now, at the very beginning, the first slide was HEFA capacity. And that obviously, HEFA capacity implies production of SAF and production of renewable diesel or HVO. When that HVO is produced, use cooking oil, is HVO class 2. And actually, renewable diesel or HVO is the real driver of production really in HEFAs. And actually, most of European plants are focused on producing HVO to meet the European demand. That, as you can see, is growing relentlessly at a much higher speed than HEFA's PK. As a matter of fact, because of the RED transposition from RED 2 to RED 3, we will expect an increase of about 30 to 35% on HVO class 2 demand in Europe during 2026. So definitely by 2030, there's going to be a lot of pressure and potentially much more demand, a lot of pressure on capacity, on HEFA capacity, and much more demand on SAF if the things develop. So when we look again at the same graph, but we take in consideration HVO demand, what happened is the market actually doesn't go balance in 2034, 35. It doesn't go balance in 2029 and 2030. Actually, 2030 appears to be short. And that is considering that the nameplate capacity is utilized. As you can see in these different ranges, with likelihood is that the capacity will be utilized between 80 and 100%. Yeah. So we are in a situation where the market needs more HEFA capacity and actually needs more capacity, generally speaking. So it needs alternatives to HEFA technology pathway, and it needs alternatives to UCO as a feedstock. So how those plants are going to meet FID, right? Now, at the moment, what we see is that plants moving forward are mostly developing in China, and in this slide, maybe it's worth to focus in the gray plants which are not operating at this stage, and they will be adding capacity. As you can see already, China has almost 3 million tons of nameplate capacity, and there are 4 plants on the pipeline, all of them HEFA. Yeah. Now, the other HEFA point here is Southeast Asia. Southeast Asia is not a new production capacity point. Neste has been producing from Singapore already for a few years back, but obviously we can see other plants like Panchak, Ecoceres already producing. There are a couple of small projects in Thailand. There is another project in Malaysia, and there's as well some co-processing going on in Indonesia. So here in this as well, the capacity continues growing as well as stretching UCO demand. So what it looks clear is that the next wave of plants, it should start giving some relief to the UCO and the HEFA capacity. And then we will need to be looking at alcohol to jet, but most alcohol to jet plants still fall in that gray area on the first slide, so not FID reach at this stage. Why it's been hard for alcohol to jet plants to reach FID? Well, alcohol to jet using ethanol as a feedstock is more carbon intensive than HEFA using used cooking oil as a feedstock, what it means that consumers of alcohol to jet, they will have to mark an willingness to pay price for alcohol to jet, meaning that they will not pay above HEFA SPK prices unless the market goes into a place where demand is so strong that they need to, okay? And the reason they today is just a willing to pay price is because they need to deduct that more carbon intensive price coming from alcohol to jet. So what happens is when you look across the last couple of years, and you can see in this graph, there's a moment where the alcohol to jet variable cost of productions versus the alcohol to jet estimated willingness to pay price actually don't work. That spread is not enough to move forward. And in this graph, we're not including capex. So we have a scenario in 2030 when the market will be very tight, meaning prices probably will be supported, and we have a scenario where prices actually needs to increase in order to allow other technologies to come in. So doesn't look like the price between jet and SAF really is going to close the gap, but it looks like it may be the other way around. However, in the middle of all of this, war of Iran, the war in Iran takes place. And obviously, 31.5% of crude oil traded globally seaborne used to pass by the Strait of Hormuz, and 22.4% of the jet fuel. That means that, obviously, as we all know, crude prices, they raised dramatically in March, but jet fuel prices versus crude, the relative price of jet versus crude, the jet fuel crack, it raised very dramatically versus the crude oil. So the flat price of jet really went very high. And we saw things like this graph here, where we compare the price of fossil jet fuel in FOB Singapore versus the price of Corsia SAF FOB Strait of Malacca. And as you can see, during the month of March, that spread narrowed dramatically. This is the closest that jet and SAF, they've been pricing to one another. And actually, maybe on average for 2 or 3 weeks, that spread was around $600, which is actually still is a lot, but obviously nothing compared with other spreads that we have seen in the last few years. And obviously, what happened afterwards is that completely different fundamentals driving UCO and SAF and HEFA capacity to the fundamentals that drive really crude oil and the refining capacity and jet fuel prices. So as the war continues, and it still is continuing today, there's been a process of relaxing of that flat price, whereas Corsia SAF price in Australia, Malacca has remained more or less stable. What it takes us to the second conclusion in this graph, and it is that obviously if you price SAF using jet plus a premium, you are exposing yourself to that spread, which is, it doesn't have a direct correlation, but as well take the market to another conclusion, and I think it fits quite well with this webinar, and is that generally speaking, SAF has been seen as a tool, a very expensive tool to decarbonize. But now it can start being seen as well as fuel security, as fuel diversity. And that is an interesting angle that hopefully help to develop the market. And another thing that the market needs to develop is risk management. So, and that is happening as well. So at the moment, the Argus SAF FOB ARA price in Amsterdam, Rotterdam, Antwerp is listed. So the market can hedge their SAF exposure when using that price underlying. So the things are actually looking somehow positive, but still developing slowly for SAF. And something that it has been developing for a while, and it is quite important as well, is to understand that if the value of the SAF physical molecules and the jet fuel physical molecules, that value, that spread doesn't look like it's going to converge anytime soon. How we fill the pricing gap? Well, in this graph, in this example, is very simple. Please take the prices as absolutely illustrative. So this is just an easy example to explain the concept. So if we take that HEFA's PK SAF, for instance, it will be worth $3,000 and jet fuel $1,000, right? The $2,000 spread, you need to fill the gap somehow. So in the case of Europe, you can take ETS as a proxy for scope 1 emissions, and in the case of the rest of the world, Corsia, once it comes into place, particularly next year, it can be actually taken as well as a scope 1 proxy. And then there are airports, governments that they put in place incentives. So they promote the usage of SAF. And a good example of this I would like to highlight is what happened in the Heathrow Airport. In Heathrow Airport, there is an incentive that actually helps airlines or suppliers to get back part of that extra cost. So what is left? It still is a big gap left, as you can see. And what is left is what is happening more and more often, which is the scope 3 deals, something that we've been hearing for a while, but I think it's going to be very instrumental for the aviation industry. And actually, you could take scope 3 as it represents the theoretical value that a seller, for instance, an airline, should charge to fully cover his SAF cost once the cost of scope 1 emissions and any other potential incentives has been deducted. And who will be the buyer of those if the airline is the seller? Well, will be corporates mostly, And we see a lot of these type of transactions taking place in Europe, and this is as well a way to move forward with SAF. So the conclusion of this session is that the market is long in the short term, where it makes very hard for new plants to reach FID, particularly alcohol to jet. However, the market points towards short balance by 2029, 2030. Therefore, investment in capacity is needed. China, Japan, India, potential mandates could be a game changer, supporting prices and tightening waste feedstock availability, thus opening opportunities for other technologies like alcohol to jet or feedstocks like ethanol. And the war in Iran enhances a new role for SAF, fuel security and diversification. And SAF feedstocks and prices are disconnected. And Argus provides tools to the market to price SAF and manage its price risk exposure. And with this last slide, I wrap up my session. Here you see the operating capacities, the global HEFA operating capacities, and our key range of SAF prices or portfolio of prices, which aim to assess the value of those trade flows. Thank you very much, and thank you for listening.
All right. Thank you very much, Alfonso. I thought that was a great opening to our discussion today. I feel like we're probably going to come back to several topics later on today. We do have one question from the audience here. They ask, considering HEFA feedstock supply fairly remaining the same, how will HVO and SAF grow simultaneously globally? Will they be competing against each other? No more HEFA-based new plants will be coming. Will there be more HEFA plants coming in the future?
So the HEFA capacity, there was a moment on the presentation. So the upcoming HEFA capacity really is coming in China and Southeast Asia, which they are becoming the production centers of the world. The question is right in the sense that HVO and SAF, they're going to compete. Yes, price wise, HVO, SAF, and UCOME. Yeah, both three products depending on used cooking oil, they're gonna compete. Obviously, the one that has more price flexibility on the upside is SAF. Yeah. So potentially from that perspective, what is happening now when SAF and HVO are pricing at very similar levels, even actually there's been moments where SAF has been below HVO class 2. That is a scenario in the market that we don't think that it will last for long. Yeah. The moment that mandates start raising, definitely 2030 onwards, it looks like if the mandates continue, which looks like, then SAF will have to price out UGOME and HVO, and obviously that will allow some space to other technologies to compete with UCO. It's very difficult to compete with UCO as a waste feedstock, as the value it is now. It's very difficult to compete with HEFA because it's the most mature technology. Very difficult. So this can only be achieved by price at this stage. So that's what we see. Yeah.
I see. Thank you very much, Alfonso. We're going to move on to the next keynote from Neil Gardner. He is the executive. Hi, Neil. He is the executive manager at Jet Zero Australia, bringing in 2 decades of energy sector expertise. Neil specializes in project development, commercialization, and strategic management. Whenever you're ready, Neil.
Thanks, Linda. Just confirming you can hear me okay? Yeah, excellent. Well, thanks, Linda, for the opportunity. And Alfonso, thanks for setting the context there so effectively. As Linda said, my name's Neil Gardner. I'm the executive manager at Jet Zero. My role is to help oversee progress across our portfolio of projects and also lead commercial and supply chain solutions. So with that lens, what I want to achieve today with you is give you an overview of Jet Zero as a company and the portfolio of projects that we are developing. I then want to deep dive into Project Ulysses, which is our most advanced project in Townsville. Take you through the way that we're approaching delivery and financing of that project. So I think that's relevant, particularly building on what Alfonso has just covered. And then finally, I want to focus on supply chain because outside of the plants that we're developing, you need a lot of support and infrastructure along the, for example, storage at port side, the ability to move through pipelines to get it to the end customers, i.e. to the airports, and also to allow the blending of the product to then make sure it's certifiable, bankable, and distributable. So there's a lot that we have to rely on here, which requires an entire ecosystem and not just single developers, but the whole industry working together. Jet Zero. So who are we, first of all? Jet Zero is Australia's most advanced and diversified project developer of SAF and renewable diesel projects. Key points are we are technology agnostic. So we're not, we haven't come up with our own new whiz-bang technology. We instead take proven high technical readiness level technology that is able to then be commercialized very quickly and rapidly deployed here in Australia and other locations. This significantly de-risks, obviously, the delivery, but also supports the bankability. These projects take a significant amount of capital, so to de-risk as much as you can and support the banks, the investors to be able to deliver these projects is critical. Another way that we've tried delivering this is we've assembled a team of industry experts across the whole major project lifecycle here. So you'll see we've got a lot of the company names there that we've got employed, but yeah, we all come from backgrounds with Shell, Woodside, Fluor, etc. That gives us the engineering, the supply chain, the finance and expertise to pull these projects together. What that has also allowed us to do is have a very strong investor base behind us. So you can see that we're very fortunate to have had key strategic investment from both Qantas and Airbus close to our inception. We've now also brought in Idemitsu as a key investor from Japan. And we've also had good support from both state and federal level that has allowed us to get to this position. We've now deployed and committed well over 70 million. Roughly 15 of that's been from the government and the balance from private. So it really shows how the private are leaning in here based off that catalysing benefit from the government. Just looking at the pipeline quickly, just give you an idea of what we're doing. So we're progressing 2 key SAF and RD projects here in Australia. Our first most advanced is using the alcohol-to-jet technology pathway that Alfonso explained. So that takes Australian domestic ethanol as the feedstock and converts it to roughly 100 million litres of SAF per annum and about 11 million litres of renewable diesel. That project is currently in feed stage. We are progressing to FID on that using Technip as our feed contractor. Second project is following the heifer pathway. So that's taking used cooking oil, tallow, canola as the key feedstocks. And that's going to be a much larger plant, roughly 400 million litres per annum. And you'll see there we're also now aggressively investing in feedstock. We're really pushing now on the Pongamia side. We have a plantation 10-hectare trial to prove up Pongami, which is basically a native tree crop that produces seeds that you can crush down into oil. That can then be used as a feedstock for the heifer pathway. So as I said, we've got first plantation there, and we're looking to scale that up rapidly in the near-term future to try and to prove that up as a significant opportunity here domestically. Okay, Townsville projects, just focusing on this now, just to help you understand how we're approaching final investment decision on this project. As you can see on the screen there, we've secured the project sites, we've secured access for the portside infrastructure, and are progressing through the design of this project. In the bottom left-hand side is a schematic of what these kind of refineries look like. That's for our specific site. What we're now trying to do is close out all of the engineering to a level of definition that gives ourselves, our shareholders, our bankers and investors confidence to say, yeah, we are now commit to this project and happy to take it through to full execution. This process step is called final investment decision, and it needs a lot of key information all coming together at the same time to allow all parties to then make that final decision and say, yes, we commit to this. So building on Alfonso's point, we also need all the relevant approvals in place, and you can see what we have there. The final approval we expect to receive is development permits, which we should get imminently. You then also have all the engineering side, securing the site, securing the feedstocks, securing the offtake, and all the relevant commercial agreements to support that. And then you have, obviously, the banks on both the debt and equity side as well, through our investors and banks, to then fund that together. This takes a lot of aggregation of all the different parties, and to the point around policy that Alfonso meant as well, for that long-term supply, that long-term offtake security is critical for these kind of projects. What you can see in a lot of other countries, which Alfonso touched on, is they've now mandated the use of SAF to decarbonise the aviation industry. We don't currently have that here in Australia, but the government are starting to look into that. And the reason that is so critical is to get these projects bankable, you need long-term offtakes, roughly, ideally 10 plus years, because that gives you the long-term certainty of the revenue stream to then allow you to fund and bank these projects and ensure that you can pay off all the relevant cost of capital. That is critical. Short-term contracts is not going to be bankable for these kind of projects. Okay, what I want to talk about now is the supply chain side. As I said at the start, building these projects in isolation is hard enough as it is. But the problem, though, is you then need a lot of other downstream infrastructure to then get the molecules that we produce to the end customers. It's not efficient for someone like Jet Zero or other companies to build all of the relevant supply chain infrastructure and then hold it for their own operations, just given the amount of capital requirement that you need, and given that a lot of that infrastructure is already in position. And so whether we can then access that through tolling agreements, third-party agreements, etc. And this is where I think we need to work together as a broader industry to achieve this. Another key point is when you produce SAF, you have to blend it with fossil-based jet up to a maximum of 50% blend ratio. You then need to recertify it before it can then be moved into a relevant airport infrastructure and then consumed by a plane. And so again, trying to manage that blend in and the provision and procurement of the fossil jet and then the movement into the airport, again, is all complexity that we're all going to have to try and find solutions to moving forward. This is where I think there's an opportunity for us within the industry in general. Trying to get these plants up is hard enough as it is, but what we're also trying to do here is create a whole new industry. And if you look at what the Middle East has really highlighted at the moment, is just how exposed Australia is to imported liquid fuels. So we currently import over 85%, nearly 90% of Australia's demand comes from international, which in times of crisis, it leaves you heavily exposed. But also, you lose out on all the other benefits that go with local production. More jobs, if you can generally catalyze all the feedstocks, they're generally in rural areas, so you're supporting rural regional development. You're supporting fuel security. You're supporting sovereign security as well from a defense angle, as well as giving us a lot more control and optionality in the future as a manufacturer of these products. And that's the critical opportunity for Australia. So the government have recognised these issues, and you would have seen recently the federal government announced the 14.8 billion strengthening Australia's fuel resilience package. There's two key parts of this. One, they've increased the minimum stockholding obligation from 20 to 30 days cover, which basically means you need more storage. But they've also specifically allocated 3.2 billion to targeting an extra 1 billion litres of storage across Australia for both diesel and jet. The reason that's important is as the government try and build all this infrastructure, I think there's a significant opportunity to do in parallel with what industry are trying to do here as well. If you look at it from a defence angle, defence have, under their national defence strategy, allocated between 14 and 18 billion through to 2034, specifically focused on northern operations. And through their defence fuel transformation program, they're focused very much on their fuel network and storage facilities. So what you've got now is both defence and government recognising that we need support on increased storage here. And then in parallel, you've got the low carbon liquid fuel industry also looking at storage opportunities. If you can aggregate all of that and get us all talking, then I believe there's an opportunity where the key most advanced projects, like for example, Jet Zero, you can see Ampol's on there, you can see I put Viva's co-production on there, but there's obviously others through Wagner, etc. If you take their foundational volume requirements at the port, for example, Jet Zero need roughly 100 million litres of storage at the port. At both Townsville and Gladstone support our two projects. If we use that as like a bankable anchor and then bring in the defence demand, bring in the government demand, you can actually justify a much larger asset that the whole industry can use if it's delivered as a genuine open access industry terminal. This provides multiple benefits, but the key one obviously is instead of all of us just creating our own infrastructure and managing it to ourselves, which is our base case, it doesn't really help everyone else get up and run it. It doesn't really help national resilience in long term. All it does is just increase duplicated infrastructure, inefficient use of capital. And so I believe there is a significant opportunity here to pull all of this together and then ultimately aim to try and create a low carbon liquid fuel hubs at all of the key locations along the east coast of Australia and potentially the west in the future. So you can see there I've just listed some of the key ports. I believe that this is an area where I think we should all work together, and I believe it will deliver long-term benefits for obviously Jet Zero, but for the whole industry if done under an open access facility. And it shows we're learning from past mistakes. If you look at how we've done some other past projects, such as coal seam gas to LNG projects at Curtis Island, it shows how hard it is when everyone works in isolation, and it shows how ineffective it can be. So thanks for your time, everyone, and look forward to more discussions.
All right. Thank you, Neil. I think we do have a couple of questions from the Q&A box that's quite technical. But before you answer those, I do have a question for you. So I think you mentioned that mandates in Australia would definitely be helpful. What other policies do you think would support your production as a supplier, especially considering the recent government budget? With that, I think a lot of people are saying that that's quite helpful for the low cost liquid fuel industry. So I'm just curious as to what you think of that.
Yeah, good question. So you've kind of got two side mechanisms you can look at, which is the supply side and the demand side. So on the supply side, obviously, we've got a lot of push there through for what ARENA are allocated and the $1.1 billion fund, etc. You've got NRF pushing through a lot of budget as well. That is all good. But as I said, the key part is that demand side. And if a mandate is too difficult to legislate for whatever reasons, there are other avenues that we can progress here. So, for example, if government instead acted as like central procurement, where they then procure to help these early stage projects get up and running, because they are a very high credit-worthy party and they've got the ability to allocate that product across industry and their own use, i.e. defense, Olympics, etc. I think that's an area where the government can lean in as a halfway house before they can then legislate a mandate in the future.
Excellent. Thank you very much. I think we do have two more questions in the Q&A box. So if you could type in your answer, that would be great. And we're going to move on to the next keynote speaker, Oliver Haas. And he is Head of Sustainability, Commercial, and Innovation at Cathay Pacific. He leads initiatives to advance SAF and focuses on engaging customers in the airline's sustainability journey. Oliver, whenever you're ready.
Thanks so much, Linda, and thanks, everyone. I'm going to share from my side. Let's just see that this works.
Yeah. Perfect.
Can everyone see?
Yes.
Fantastic. Well, thanks so much for inviting me to the forum, Linda, and thanks everyone for being here as well. I was tasked to talk a little bit about voluntary SAF, in particular, perhaps the opportunities that we see in Asia. And in doing so, I'll kind of share a little bit more about the airline perspective on this whole puzzle as well. Of course, I would love to leave some time for Q&A at the end for any questions, so I'll make sure to try and keep time. I think the first place to start with sort of thinking about a SAF from a customer's perspective, or the voluntary SAF market, is this is really one of the first time that our customers have a direct way to contribute to decarbonizing aviation. So like can actually sort of play a role. And this is beyond compensating with, say, carbon offsets. Of course, from a customer's perspective, they often still are comparing what SAF means versus what an offset was. And, you know, obviously there's a price difference there, but in their mind, they're sort of looking at this as a solution to help decarbonize their aviation footprint. And SAF or SAF certificates, for that matter, are a really direct way for them to do so. And of course, one of the key enabling pieces to this puzzle is book and claim. I think we have a fairly SAF advanced audience here, so I'm not going to explain too much about book and claim. But principally, the idea of being able to separate and trade the environmental attribute from the physical flow of the fuel allows the scaling of SAF beyond just the physical constraints of where it's produced or where it can be moved to efficiently for logistics. I will say, however, that we are still, as Cathay Pacific, we're still actually very cautious on this, and I view this positively. While we definitely view kind of book and claim as the right way to scale the industry, we are still in a state where we don't have necessarily all the frameworks and infrastructure in place for that to happen in a high integrity way today. And so what that means is we need to be quite careful. This is now kind of my view, is I want to be careful that the SAF market as it grows does not face the same challenges that the carbon offset market or the carbon credit market faced. And when we were thinking about the carbon credit market, these are sort of some of the key challenges, if you will, that always come up, right? Integrity. How do I know what I'm buying, like the offset that I'm buying, or now the SAF certificate that I'm buying? How do I know that that's real? And how do I know that I can credibly report against that as a corporate? Additionality. How do I know that what I'm doing is actually helping to catalyze, to helping to move forward and helping to grow more production, as Neil was talking about just now? And then how do I also ensure that there's no double counting? How do I ensure that the certificate that I have in my hand is not being shared with anyone else for their claim? And so again, these are common questions already when we were looking at the carbon market. And I think I would safely say that from my perspective, they're slightly easier to answer for SAF, or at least slightly easier to contain for SAF. Today, the integrity question is answered through certainly very robust certification in SAF. We sort of have two leading certification bodies, ISCC and RSB. They continue to improve, but they do sort of set the foundation for integrity in the industry. On additionality, there is a variety of conversations that happen here, but fundamentally to me, the line is pretty black and white clear, which is we separate the voluntary activity from the mandatory activity. That means an airline like Cathay Pacific, we have mandatory obligations today, most notably in the EU and the UK. But as Alfonso was mentioning, increasingly, a lot of our Asian destinations are going to have some form of SAF mandate or policy in place. So we're going to be using mandatory SAF as an airline. Very fundamentally, very black and white, very clear. We separate voluntary SAF from those mandatory obligations. That means if a corporate or a customer, an individual traveler purchases SAF from us, that is separate from our mandatory obligation, and that is clear therefore from an additionality perspective. And from a double counting perspective, there's many new registries appearing. There's almost a new one that appears every week, it seems at this point. But fundamentally, what these registries are trying to do is solve exactly this problem to ensure that there is essentially a public book that prevents double claiming and double counting of SAF. And we, as an airline, we support all these registries. At the moment, there's not a clear standout, but this is kind of an evolving space, and it's important for the integrity as well. With all this said, there's a lot of great development, and I'm going to be talking more about the development, but it is important to sort of do the reality check. And of course, this is hot off the press from the IATA annual general meeting just a few days ago. IATA's numbers show that the industry still has failed to reach the 1% mark on SAF. So we still have essentially significant underinvestment and underdevelopment of SAF. The volumes are still low. There's still a drop in the bucket for what we really need to decarbonize aviation. So that's the kind of reality check and playing field. And the way we look at this from an airline perspective, but this is generally across the value chain. Again, Neil just mentioned this as well, is we need all hands on deck. One of the challenging things about aviation is not only is it a hard to abate industry, but you can't. No single player in that industry can solve the decarbonization problem. We as an airline, we can't. We need to collaborate across the value chain. Sorry, I should say we can't alone. We need policymakers involved. We need investors. We need the energy sector heavily involved. We need airports, even from an infrastructural perspective. We need corporate partners and customers and other stakeholders who are involved in this whole puzzle, right? So it's kind of really that the message is it's a multidimensional piece to help scale SAF, and voluntary SAF, which I've underlined here, I've said corporate partners, but actually more generally it's our customers, play a key role in that as well. I'm really excited to be positioned in Asia at this stage. I really think this is Asia's moment, and maybe sort of 5 years ago, maybe some would not have predicted that Asia Pacific is in the position that it is today. I think we're seeing momentum happening on a few fronts. We're seeing actually a lot more collaboration happening around the voluntary market. This is a picture from the Green Fuel Forward initiative. This is an initiative brought together by the World Economic Forum that specifically is looking at how to scale Scope 3 and demand for SAF among corporates in Asia Pacific. There's also, you see a lot of collaboration now between various SAF suppliers, corporates, airlines. There's activity happening. And particularly one thing that's quite interesting in Asia is, of course, because you have so much of the world's production capacity exists here for everything. The whole narrative around logistics and cargo and decarbonizing logistics and cargo is very strong in this part of the world as well. So really excited about what's happening in the voluntary market. But again, as Alfonso mentioned, another thing that's just really interesting and more sort of recent is the momentum on evolving SAF policy and mandates that are being announced in one form or another in the region. I think that from my perspective, that's just growing the discourse and dialogue, if you will, around SAF. And so ultimately, this is also going to help, I think, with maturing and growing the voluntary market in this side of the world. To take a lens on Cathay, so we sort of also part of this wave, if you will. We were the first airline in Asia to start a corporate program, really, and fully, honestly, and humbly, this was an experiment for us. We, at the time, were in very much a region that did not have a SAF policy around us, either on the supply or the demand side. And so we really started this as an initiative to help try and scale our voluntary usage as an airline. Today, so our program's about 4 years old. Today, we continue to grow and maintain the kind of position as one of the strongest programs in the region. And that is, of course, only enabled by our work together with, or collaboration with, key partners. This is sort of what our scale looks like. This is a sketch, but this is actual data. So our 2025 SAF usage was enabled by through the corporate SAF program, through our voluntary program, if you will. It was around 17,500 tons. Still a drop in the bucket, to be clear, also for us. But again, the curve and the trajectory here is also what matters. And as said, this is enabled by our walking along giants. I really need to take a moment here and pause here. I'm fortunate enough to be, I lead the team that runs our voluntary SAF initiatives, and I don't wake up any morning taking this for granted, right? So every company you see here, and there's some more who are not in the grid, every company you see here is going above and beyond. And no matter the scale that they operate, no matter the budget they have, some are much smaller, have much smaller contributions, some have larger, but fundamentally they're putting money on the table to help decarbonize aviation and to help scale SAF usage. And so I really want to take that moment to also kind of celebrate what they're doing. And to peel the onion a little bit on what they are doing. So some of the leading corporates that you'll see in the space, really, if I kind of identify 3 leading actions, it's really these actions from my perspective. First is they're diversifying. So you'll see a lot of multinationals, they'll be diversifying their SAF supply across regions. So Europe, US, Asia Pacific, different suppliers, and over time, also different technologies and pathways for SAF. So this, of course, has been a great driver for Asia. You have a lot of multinationals who are increasingly looking to decarbonize part of their Asia value chain and looking to support SAF usage and catalyze SAF usage in the region. So that's been a really great drive. You have increasing sort of activity around long-term commitments to 2030 goals and beyond. And this, of course, helps to build the demand signal for SAF that can support projects like Jet Zero and others to come to fruition. And then I think another really interesting thing is this third point is sort of leading without a perfect rulebook. The voluntary SAF industry is still young, which means there's a lot of evolving standards, best practices, registries. There's no singular authority that sets the rules for the voluntary market. And that means that it's not always so black and white on how and what you can claim, and then the right ways to claim it, and the right ways to deal with different certification and different certificates, etc. And so what you really see with the leading corporates in this space is they're navigating despite all this uncertainty. They're taking action, and they're doing the best they can with the information that they can. And here we kind of walk alongside them, and we work together, both to advance the industry and help shape standards, but also to help support them as they're kind of navigating this space. So I think that's just kind of a really interesting piece to highlight. Another thing to mention is, so the next frontier for us is sort of moving beyond corporates to really engaging our everyday travelers and people. Of course, here, what you have to do is very different from what you do for a corporate. The value proposition is very different. An individual traveler cares less about a Scope 3 reduction certificate. We are still very adamant that we will give them a Scope 3 reduction certificate, but you have to find additional ways to kind of create value for passengers. And here, the top line for me is that, generally speaking, SAF has been viewed as an extra burden, an extra premium, an extra cost. That is, of course, true. But there are some really interesting and creative ways that you can package SAF, bundle SAF, and reward and incentivize purchases of SAF among everyday travelers that we're only scratching the surface of. So today we have a program where we incentivize SAF purchases with miles. There's a lot more we can do getting closer to loyalty. And even you'll see some airlines that have like bundled fares that do really interesting things to encourage people to purchase SAF. And I think, again, this actually can be, in my view, a very scalable approach, particularly also in Asia, if you hit this value proposition right. But we're still in early stages of exploring that. As Cathay just mentioned, beyond the kind of activity of running our voluntary SAF program, as well as also our mandatory SAF engagement, we do a lot of work to kind of help advance SAF and scale SAF beyond the day-to-day and thinking about the tomorrow. We have memberships across different parts of the value chain, and we also invest in SAF. So we are one of the launch investors in a fund with Breakthrough Energy Ventures and One World, helping to scale next generation technology of SAF. And we also have a co-investment partnership with Airbus, where we're looking at a whole range of projects and opportunities to help bring us closer to our 2030 goals and beyond. So kind of my takeaway, if you're sort of in this call, if you're looking at how to support SAF, either as an organization or if you're part of an initiative that can provide this support, my sort of key takeaways are: first, every drop counts. The engaging in voluntary SAF purchases can feel a little bit daunting, maybe, and especially if you feel that you don't have a large budget for it. But if I go back to the reality check of where we are today in SAF, literally every drop counts. And really what voluntary SAF represents is it represents a demand signal. So even if you are a smaller company, if you have limited budget today, that demand signal still counts. Lead where you can. Again, as we talked about, there's kind of the leading partners we work with. They're diversifying their sourcing. They're doing the long-term offtakes. They're helping to shape the market as it evolves. And again, to whatever degree you can, that's really important. And then this last point is also sort of turn that SAF premium into value. SAF does cost more, but it can be used to engage customers and create new value. Just as an example, we were speaking to a property developer the other day, like literally yesterday, sorry, that was looking, they have a whole set of programs where they engage their tenants in more sustainability forward actions, from recycling to sustainable procurement. And they engaged with us because they were saying a lot of their companies want to learn more about how they can reduce their business travel emissions. And this property developer sort of proposed partnering with us to support SAF usage for their clients, and in return, the property developer would reduce the management fee for those clients. So there's like all sorts of interesting ways that we can scale this proposition, and just encourage you to think about SAF comes at a premium, but it also comes with a value. So with that, I will pause. I'm not sure where I am on time right now, but if there's any questions or thoughts, happy to answer those. And I know Ian also had a question about electric aircraft, which I'd be very happy to talk about for a second.
Yeah. Cool. Thank you, Oliver. That was very insightful. I think as a sustainability professional, I definitely agree with pretty much everything you just said. As much as I would like to have you answer live, I think we're running a little bit short on time. So could I please ask that you type the answers for those questions in the question box? And I think we'll probably move on to the next keynote from Antti Mikil. And yeah. Okay.
Thanks, everyone.
So Antti Mikil, he is joining us from Europe today. So thank you for getting up bright and early. Antti, if you would like to start.
Yes, thank you. Thank you, Linda. Thank you for having me. I will share my slides. Just a second. And, one more second. Should be coming up now. Great.
Okay.
Can you see the slides?
Yes, I can see the slides.
Very good, thank you. Okay, so first of all, thank you for the great presentations so far. So my name is Antti Mikil. I work for IATA. I focus on SAF topics, mainly supply and demand analysis, but also participating in different type of SAF studies. And I have background from Neste, mostly working with production and assets and supply chain in the oil products and in the renewable products side. And indeed, it's a bit of an early morning for me, so bear with me today. But okay, let's get started. So just a couple of words about IATA first. So we are a global trade association for the world's airlines. We represent over 370 airlines currently, which covers about 85% of the global air traffic. And well, on the slide you can see our main offices and a bit of our core activities. But since we are talking about SAF today, I'll just quickly mention that IATA supports the SAF scale-up through analysis, policy advocacy, and then, of course, working with a number of key stakeholders like ICAO. And some of the analysis you will, of course, see in this presentation. And then maybe final thing to comment that one of the concrete solutions that IATA has developed is, of course, the CADO SAF registry. Very briefly, the agenda. So today I'll start by discussing the airline's profitability and growth prospects, and then I will touch on the near-term and long-term SAF production outlook. It might overlap a bit with Alfonso's presentation, but hopefully not too much. And then lastly, I'll wrap it up with what we think are some of the enabling conditions for the SAF scale. Then, so here it's a bit busy looking slide, but the first point I want to make is that even in the best of times, the airline industry earns much less than many other industries on average, and suffers from low margins. And this is quite relevant to understand and keep in mind when thinking about how the airlines can absorb different type of shocks and fund the energy transition. And as we all know, at the moment, we are certainly not having the best of times. So the current, let's say, oil and jet price shock has, of course, tested the airline financial resilience, and we are now estimating that the average global net profit for the industry is expected to be around 23 billion USD, which translates into 2% margin. So that's for this year, and much less what we expected, let's say, before the crisis. Then looking at the net profit per passenger, we expect it to fall to 4.5 USD. And this is, as you can see, about half of what it was last year. And let's say under these circumstances, this of course shows resilience, but is still very, very low. And then if we look at the regional picture, the Middle East stands out with quite a drastic drop. But what is good there is that the region entered this downturn with the strong balance sheets. Also, APAC Airlines, you can see here, and they have lower profitability compared to many other regions, which of course also set some boundaries and is good to keep in mind. Then when it comes to aviation growth, APAC is really the region that stands out here. So it has the highest growth prospects, and actually the air traffic from APAC is expected to nearly triple by 2050. And well, this of course means that a lot of stuff is needed. But so far, the strongest aviation growth has not yet translated into strong margins. Then moving into SAF, and well, it was already mentioned, and I think we all know that the SAF share of the global jet fuel use is still very, very low, less than 1%. And globally speaking, IATA estimates that the SAF production will reach around 2.4 million tons this year, which would mean that the growth of production is also slowing down a bit compared to previous years. And actually, interestingly, the already installed production capacity could support higher production rate if we, for example, had the, let's say, right tools in place to bridge the cost gap between fossil jet and SAF. Another thing is that the existing capacity is spread quite unevenly. So, for example, in APAC, the Singapore Strait area and China have quite strong capacities, but we, of course, still lack production in many countries like Australia and India and, well, many others. Then, yes, so bit of advertisement. The SAF facilities map that you can see on the slide can be found on the IATA.org SAF page. along with global policies map. So if you are interested, go take a look on that. Then next, looking a bit further, so the announced global SAF capacity amounts to around 30 million tons in 2030. But many of these projects are rather uncertain. And if we take out the least likely pipeline, we could have around 20 million tons. But of course, even that requires some hard work and supportive conditions. Most of that 20 million tons is expected to be in the Americas, around 8 million tons. But actually the split between Americas, Europe, and Asia is quite even, as you can see, with Africa and the Middle East having the lowest capacity. And then, like in today's market, by far most of the SAF behind that 20 million tons number is HEFA-based biosaf, actually around 95%. And we all know this has to of course change as we go forward. So we need the other technologies as well. But at the same time, we need to recognize that HEPA really is the most mature and cost-efficient way to produce SAF at the moment. And therefore, we should enable as wide HEPA feedstock pool as possible to make most out of this technology. Then just a final note, reminder that what we saw here is indeed the capacity and not the actual production. Then if we briefly think about the road to 2050 and hopefully the net zero CO2 emissions for aviation, I think it's clear and safe to say we need everybody and everything on board. So we need all the regions, all the feedstocks, all the technologies. We need biosaf, we need eSAF, we need lots of both. In fact, 500 million tons in total in 2050 is what we estimated a couple of years back. And this is, of course, quite massive number. So a lot of work to do. And we published a global assessment for SAF production at the end of last year. And we concluded that when it comes to the feedstocks and technologies, we have them to make this transition happen. But of course, this doesn't happen on its own. So we need a bunch of tools and a lot of support and, let's say, enabling conditions like we had, for example, for wind and solar. And if you are interested about this study, you can access it by scanning the QR code at the bottom of the page. Then to conclude this slide, when it comes to Asia, the region, of course, has a great potential, large potential availability of biomass feedstocks. And this is not just an opportunity to decarbonize the growing aviation sector, but also to create jobs and, economic growth and enhance the energy security. Good. Checking the time. Very good, very good. Then we are almost at the finish line. This is actually my last slide. So here I will just touch on some of the key elements that we think are should be there to enable the SAF scale up. So if I start with the policies, we think that it's not just about what are the right policies, but also in what order they are introduced. For example, it may not be wise to introduce demand pull policies before there is appropriate supply to be pulled. This will just increase the price, as we have seen in Europe with the introduction of mandates. And then, maybe another example is the upcoming 2030 eSAF sub-mandate in the EU, when the infrastructure and the technologies or rolling out the technologies is quite not there yet. And yeah, I think it's safe to say that the supply will almost certainly fall short and result in high costs and no emission savings. So we think that the technology push policies should come first to make sure that the supply is ready. And then if the mandates need to be introduced later, they should be, of course, well designed and coupled with instruments. So basically incentives to then avoid any unintended consequences. Also, the government should help with setting the demand signal and not leave it fully on the shoulders of the low-margin airline industry, and basically lead the way by purchasing the SAF for their own use, for example, in defense or their own travel when it comes to government officials and civil servants. I think this was also mentioned in the previous presentation or one of the previous presentations. Then, being mindful of the time, I think I will wrap it up right about now. I'll just in the end quickly mention that another thing that we really think is needed and part of the essential market infrastructure is really the book and claim system, also mentioned in the previous presentation. This, of course, will help to scale the market. But that's it. Thank you for listening, and I believe we may have a quick Q&A session or not, depending on the time.
Yeah. Thank you very much. We do have quite a few questions in the Q&A box for you as well, and I do also have questions, but since you're in our panel as well, I think I'll probably save these questions for the panel. So let's welcome our next keynote speaker, Phil Moore, who is also joining us from Europe. So thank you for joining us early in the morning. And he will be delivering our last keynote.
Yes, good morning. Hopefully you can hear me. It is indeed early in the morning here, and unfortunately raining, so not even a nice day to look forward to in Switzerland. So today the topic that I will address is SAF trade from Asia to Europe. I think some of our previous keynote speakers have touched on the trade imbalances between the areas. So I will share my screen, and hopefully this works. All right. So just to give people an introduction to myself, I'm the global head of SAF at Eco Series. I'm based in Zug, Switzerland. I'm originally from New Zealand, so Australasia is obviously a very keen part of my heart. To give you an introduction to Eco Series for the people that don't know it, we are a technology company that is backed. Initially, it was incubated by Towngas, who is a Hong Kong company, and they are the municipal power suppliers in the Hong Kong area. And we had substantial investment from Keragen Capital, which is a Anglo-Australian Hong Kong investment company, and then later on from Bain Capital, which is a very large American investment company. Some people in Australia will know Bain from their investment in Virgin Australia. We talk about turning...
Sorry, just a short interruption. Your presentation isn't in full screen. So
I'll try that again.
Yeah.
Is that better?
Oh, there we go. Yeah, that's better. Thank you.
All right. Sorry about that. We use HEFA technology. This creates, and we have what we term as second generation HEFA refineries. That means that we have very high stable yields of SAF capability, and we are currently producing SPK, which is neat SAF, and HVO, which is the road transport fuel. We also produce bio-naphtha from one of our refineries as well. And beyond the HEFA technology, we also have second generation ethanol production, also in China, and that is cellulosic ethanol, and that's made from empty corn cobs. Our two production plants, our first one was in Zhangjiagang, which is near Shanghai on the Yangtze River. That produces 350,000 tons a year of liquid renewable. And currently we are running that with around 80% SAF production. And that gives us a very good GHG reduction as well. Our typical GHG reduction for the SPK coming out of this refinery is around 92%. We recently last year opened our second facility. This is in JB in Malaysia. For people that know the area, it's just across the creek from Singapore. And if you fly into Changi and you look out your right-hand window, if you're landing over the Malaysian peninsula, you will see the lights of our refinery brightly on below you. That gives us a total output of 770,000 tons a year. And we recently also made an announcement about a third investment in the Greater Bay Area of Hong Kong. At this stage, that is still subject to FID, but if that goes ahead, then that will be between 450 and 500,000 tons of production as well. The next thing to consider is how do we, what standards do we make this to? We are fully ISCC and CORSIA compliant. If you think about what does an airline need, what an airline wants is to make sure that it's buying SAF that is certified, compliant, with no suggestion of fraud, that it's 100% waste and renewable product, and internationally recognized and trusted. What airlines don't care about is where it's from. They just want to make sure that they have rateable supply and that it is 100% renewable. So looking forward, I think some of this has already been discussed by other speakers. This is a slide that shows global demand. It's fair to say if we look at this, you can break it down into three areas. Looking at the US first, this is very much a self-contained area. That's supported by incentives where various mechanisms are helping bridge that price gap. More state by state, obviously there's bigger incentives in some states than others. You might imagine that those incentives are maximized in the blue states rather than the red ones. If we look at Europe, it's led by mandates, and those mandates are growing very quickly. And there are two basically types of mandates. One is the EU, which is volumetric, and the other one is the UK, which is based on GHG reductions. And then the third global area, if you like, is Asia Pacific, where this potentially has the biggest growth in aviation demand going forward, but it's a very slow burning market at the moment. The mandates that are coming in are quite small. Singapore, which we applaud, has done something slightly different. They have a levy system of 1%, which will be applied in 2027. So people that fly out of Singapore will be paying 1%, will be paying a fee, which they hope is equal to around 1% of SAF uptake. Japan is targeting 10% in 2030, and various different other countries are also targeting small volumes. Now you look at the opportunities and where do we sell today? So with our two productions in Asia, we do sell to the Asian and Pacific area. I think it's well known that we were the first bulk supplier to Qantas in Australia. Our product's also going into the Australian Defence, as well as we have supplied New Zealand. We are supplying into Japan, Korea, Malaysia, and with the new Singapore levy coming up, we are also expecting to be a supplier there as well. Still, however, the bulk of our business and our customer base is in Europe, and that is because of the mandates that are driving that demand. What's important to note also here is that even though we produce the product in Asia, the SAF doesn't change quality. Whether or not you produce it in Europe, or you produce it in Asia, or you produce it in America, then it still meets the same global qualities. If we look at what the oil industry has done, and it's good to look at what they've done. That, you know, the oil industry has had over 100 years of experience in trade flow. What you can tell is that refining follows feedstock. Now, this is a bit of a controversial slide here because it's highlighting the Middle East as a big supplier, but you know, the events today in the Middle East, it seems to be once in a lifetime. I don't think I can remember at any time where that product flow from the Middle East was closed off completely, and hopefully we resume that flow very soon. But the story on this slide is to highlight the fact that refining investments are these days made where the crude oil is. So it doesn't make sense to build new refineries for oil products in Europe. Nobody is talking about that. Nobody wants a big oil refinery sitting next to them. But in the Middle East, it makes sense. If you've got crude that you're pulling out of the ground, you may as well build an oil refinery next to that. It creates efficiency in the supply chain, and then that gets exported to the markets. It's going, obviously, I think we should all know from recent events where that Middle East trade goes. So it's coming to Europe, it's going to Asia, and eventually at the very end of a very, very long supply chain, it goes to Australia and New Zealand. It's logical to me that the SAF value creation will follow this. So I know there are a lot of discussions around building SAF plants in Europe, but at the end of the day, they're expensive. Labor costs are high, land costs are very high. It's very, very difficult to get planning permission for them, and you're still moving the feedstock mostly from Asia to Europe for that production. So as most of the currently available feedstock is in Asia Pacific, it's quite logical that you would build refineries, and you see refineries being built in this geographical area, and for those exports to go to the markets where the demand is. And on that basis, at the end of the day, what we're trying to do here is solve a CO2 problem. We have one atmosphere. It doesn't really matter whether or not we create the product in Asia, America, Europe, or wherever. It's still providing the same solution. So there's a lot of talk and a lot of interest from the airlines in book and claim. We are supportive of that as well. We see that book and claim creates efficiencies, and it's important that we try and build efficiencies into the supply chain to lower costs. Some companies, mostly oil companies and legacy oil companies, are investing in the renewables sector, and some of those companies are based in Europe. They are pushing very hard for protectionist policies. I think we've all learned, thanks to President Trump, that we've learned who is paying for duty and tariffs. And unfortunately, if these few individuals had their way, then any tariffs that were applied to imported SAF will lead directly to inflation on the cost of SAF. And that isn't very helpful, because that will mean it's more expensive for passengers to fly, more expensive for airlines to operate, and more expensive for voluntary decarbonisation. So I appreciate people have made investment decisions, but these are commercial decisions, and if they have not taken into account supply logistics in those decisions, then the market should not pay for those mistakes. So we're very much in favour in open trade policy, and we think that that should support logical trade flows. This also includes, obviously, Australia at the end of the day. If people want to build a SAF refinery in Australia, then what they should be looking at is the availability of feedstock, which there are plenty in Australia, but they also have to look at the market. And today, if you built a SAF refinery in Australia, then you would use it for exporting your product to Europe or to the US. So some takeaways today. We should focus on maximizing the decarbonisation, but not the geography. It shouldn't really matter where we find that solution. What we need is the solution. And global trade accelerates SAF adoption. That's the second point, right? If we just sat and said we're going to solve our own individual country problems, then it's going to be very, very delayed, and we're facing a climate crisis, not an international trade crisis. So the optimum pathway today, Asia supply plus European demand, is the optimum pathway. Now that may change going forward as mandates and voluntary demand in Asia increase, then that arbitrage opportunity to Europe may close. We will have to see how the market develops. Certainly today, there has been talk about, Alfonso touched on it, whether or not China would have a SAF mandate coming up. Of course, if that happens, then that could easily suck a lot of the Chinese production and trap that inside China, in which case that will create even further problems for decarbonisation for European airlines. But today, the way we see it is most of our production is going towards Europe. Anyway, thank you. I hope I have given back some time, and any questions I'd be happy to take.
All right. Thank you, Phil. That was very insightful. And I think it sets up a nice backdrop for our panel discussion as well. We do have Mia also from EcoSerious joining our panel, so I'm going to save my questions for the panel. And thank you again very much for speaking about connecting continents. I think we do have one question in the Q&A box for EcoSerious. So if you could type your answer in there, that would be good. All right. So next, we're going to move on to our panel discussion. We have Auntie Mikil from before joining us again, and then we have Mr. Chi Yalchek, Ms. Mia Eo, and Mr. James Williamson joining us for this panel discussion. Welcome all. Can you all hear me okay?
Yes.
Yeah. Okay. Cool. So my first question is going to be for everyone. So from your own perspectives, what would you want to see in policy frameworks? Could we please maybe start with Mia from EcoSerious? And also feel free to briefly introduce yourselves before you answer.
Hi, this is Mia from EcoSerious. I'm the VP for feedstock sourcing based out in Singapore. So I think what I want to see for self-development would be ideally a more common and science-based framework such as CORSIA. So the airlines to accept feedstock framework like CORSIA.
Okay. Could we next have James?
Hi everyone, James here from Neste. I'll try to be a bit original and not fully repeat what some of my previous colleagues have said. But look, Alfonso at the beginning of this great session, he mentioned how there's actually an oversupply, and at least in HEFA terms at the moment. And so there's a lot of targets that seem to aggregate around 2030. But one thing that would be super helpful from the industry, at least from a demand point, are incremental targets that take us up to these 6 or even 10% targets so that the market has time to adjust. Very much agree with Mia about this international interconnectivity or adopting science-based methodologies, because that's also very important, because aviation, as everyone here knows, is a global industry. And so having that interconnectivity definitely makes a lot of sense, and it makes it much more practical and commercial as well. But thank you.
Thank you. Could we have Check, please?
Hi, I'm Check. I head up commercial for DHL in Singapore. DHL, we've been one of the biggest buyers of SAF in the world, and pretty much driving that is a voluntary demand. We see a lot of that, and we've been, really advocating that to end users. what I would like to see is really more supply. I mean, we've put in a lot of orders. Some orders don't even have capacity yet to fill. So yeah, more supply would definitely be the thing that DHL would like to see going forward.
Okay, I think that makes sense. I think what we're hearing today repeatedly from all of our speakers is like there's a shortage of supply. And we'll come back to that later. So could we next have Auntie Mikhail for the same question?
Yes, thanks. Thanks, Linda. So Antti Mikael again from IATA. So basically, well, first thing to mention is that I definitely agree with Mia about the CORSIA. I think that's also a great way to, harmonize the policies in Asia and use something that is already there. And then I think it's also a great way to really utilize that feedstock potential in the region and not have a, let's say, too stringent framework. But then, in my presentation, I mentioned about the sequencing of policies, but maybe I'll just focus a bit on the upstream. So basically, also what needs to happen in the upstream, and governments indeed they need to think about the full value chain. And if we start with the feedstocks and other inputs, it's really important to take a look if they are available. Are they available in affordable prices? Because of course the feedstocks, they make the biggest portion of the cost of production. And it's not just the biomass, but also the ESAF feedstocks. So basically renewable electricity and CO2 to produce the green hydrogen. And then of course you need to look at the infrastructure and supply chain. How is that looking? Is the supply chain ready to collect high portion of those feedstocks, process them, distribute them? And also if we look at the finished product or the intermediate, is there enough blending capacity for SAF? How does the airport access look like? This is very important for the new emerging companies that doesn't have the supply chain capabilities in place like the oil companies have. I think this was also mentioned earlier in the presentation. And then maybe just a final comment is also that when it comes to supporting the facilities, I think it really starts with the research and development. One need to focus on that. You have to help the pilots. You have to help the demo facilities, and then of course the commercial facilities. So it's really a number of stages. Mm-hmm. Maybe I'll stop there. Thank you.
Okay, thank you. So moving on to our second question, I think a lot of you guys mentioned the challenges in the APAC SAF market. So from your respective viewpoints again, what challenges and what other opportunities you see in this market? Could we start with Czech, please?
Sure. I mean, from DHL perspective, we see quite a lot of opportunities. First of all, aviation is growing really quickly in Asia Pacific. I think much faster than any other region. So in terms of demand for SAF, I think there's a good long-term demand potential here in Asia Pacific. Also from the demand from the corporates is rising. I think the corporate demand was a little bit slow off the block, but in the past couple of years, I've seen a big growth of corporates that are interested in getting SAF from us. So we have a product that we call Go Green Plus. What it is really just insetting with SAF, and we do it by kilogram. It's a kilogram rate. And that product has been taking off very, very strongly, not only in Singapore, but throughout the whole of Asia Pacific. I think, to me, it really signals a very strong demand, because the way we track it is a percentage of our revenue. So if you're having a high growth revenue because of the strong aviation growth in Asia Pacific and a growing percentage on top of that, I think that's really a very positive sign for the SAF market in APAC. Thank you.
Okay, so it sounds like there's like a very promising market in the future then. Could we next have Mia for the same question?
I would like to share about the challenges from the feedstock sourcing perspective. So it is absolutely very challenging, and in some ways it's even more complex than building the plant itself. So the technology is largely proven. Competitive advantage is in securing sustainable and traceable and cost-effective feedstock over the long term. So I see three main challenges. First of all is the fraudulent cases and integrity risk. In waste-based markets, I think there is risk around origin, volume, and sustainability claims from mislabeling and or blending virgin oils as waste through to falsified documentation. This directly affects eligibility under SAF schemes, and it also can lead to loss of incentives, retroactive penalties, and also reputational damage. So EcoCeres has responded with robust supplier due diligence, independent audits, digital traceability tools, and contracts that allocate liability and demand transparency end to end. I think the second challenge that I also see is the regulatory sustainability and trade complexity. So each jurisdiction, the EU, UK, US, and emerging Asian schemes has its own evolving rules on eligible feedstocks and also certification. On top of that, anti-dumping measures, carbon-related borders adjustment, and import tariff can suddenly change the economics of cross-border flows or open and close markets overnight. I think something to watch out is also the Indonesia DSI measures, which will be fully implemented starting from 1st of January next year, and also the EU deforestation regulation, EUDR. They are also very good examples of the new pressures. For a regional player, sourcing strategy must be built with optionality, so portfolios stay compliant and also bankable across multiple regimes. Then lastly will be the competition and the price volatility. As mandates grow and also more capital flows into renewable fuels, the same pool of sustainable feedstock is actually being targeted by biodiesel, renewable diesel, SAF, in some cases also oleochemicals users. So this tighten the availability and also drive regional imbalances and also rapid price swing. So EcoCeres, we manage this by focusing on long-term partnerships at source, and also investing in local infrastructures, and so building win-win relationship that gives suppliers predictable demand and also give us secure and traceable volumes. So feedstock sourcing is challenging, but it's also where a company like EcoCeres can really differentiate. So our experience in Asia, 100% waste-based approach and integrated view from feedstock to finished fuels are what turn these challenges into a competitive strength. Thank you.
Thank you, Mia. I think we'll probably come back to the feedstock challenge later on a little bit more. So James, could you answer the same question on what are the challenges and opportunities for APAC SAF market?
Thanks, Linda. Yeah, there are quite a few. Look, one of the big ones that underlies any sort of international market is this idea of having policies that connect. Again, particularly in aviation. And so one of the challenges, is that as many of these new markets that have been mentioned by our speakers today evolve, that they might evolve or they might sort of develop frameworks which don't align, which can lead to inefficiencies or friction, particularly for international airlines or businesses where you're trying to operate multinationally across maybe several regions, as isn't the case with DHL. So having some sort of consistent underlying policy, albeit something like CORSIA, makes a lot of sense. Driving that, ideally, these objectives, these targets, and how we analyze the relative credentials of these feedstocks should be science-based. Tied to that, what we're seeing more now is this idea of protectionism. So, trade barriers, that's also been mentioned by some of our speakers today. And so that can also lead to inefficiencies. Hydrocarbons, be it conventional or renewable, generally global market, they tend to move around where it makes the most sense from a cost perspective and supply chain efficiency perspective. So creating trade barriers, whether it's tariffs or other sort of barriers, can lead to inefficiencies. And ultimately what that means is that these fuels will be less competitive, which is particularly important as they already can often trade at a multiple or at least a premium of their fossil equivalents. The other thing I just probably, this is almost like a bit of a giveaway, but the cost of business is also going up, both in terms of operation. We've seen that, as I'm sure that many of the businesses that are on this call today have seen. But then the other sort of point is that in terms of opening new facilities, that has also gone up quite dramatically in recent years. When Neste first undertook Singapore many years ago, the cost was a fraction of what we face today. And we see this firsthand as we're currently in the process of expanding Rotterdam by another 1 million tons of SAF production, and that number is obviously much more. So these are all factors to consider in expanding this industry, particularly in the context of trying to be competitive and bring the cost down versus conventional fuels. One other thing, sorry to keep going, but just on the side is that in terms of carbon or GHGs, the cost to decarbonize in terms of credits or abatement, you could make an argument that it's been in a bear market for some years now. And so the argument for low carbon liquid fuels, I think what we're seeing now is that has migrated away from purely being a decarbonization only solution, but also something more around fuel security. And so as this sort of narrative changes, I think it's a challenge, but it's also an opportunity for many of our stakeholders here.
All right. Thank you. Auntie Mikhail, do you have anything to add?
Yeah, well, it has been mentioned that some parts of APAC has some good capacities already, but then indeed some countries are still lacking the SAF production and probably want to participate in the market and create economic growth. But then of course SAF is more expensive to produce compared to fossil fuels. And then what can be done then is, of course, one thing that the countries can look at is the co-processing, at least as a transition solution. So that can be a bit cheaper option and also quicker to deploy. And then, of course, the CORSIA has been mentioned many times. I will still mention it here because it will allow a variety of feedstocks that are fit for purpose for APAC. And then it will also help with the policy and sustainability framework fragmentation issue. Then when it comes to opportunities, I think one opportunity is to learn from the policies elsewhere in Europe, in US. So what worked, what didn't work, and then use that knowledge. And maybe another thing is again the book and claim to really, leverage and take use of that great feedstock potential in the continent and the installed capacities and supply other regions as well. And I think few people have already mentioned the open trade flows. I think Phil did also in his presentation, and that is definitely what we are supporting and like to see as well. Thank you.
Thank you. So I think you mentioned that we do have a lot of different feedstocks to explore. We have like 11 plus pathways to producing SAF. So I'm curious as to which type of feedstock is the most widely accepted one and the most commercially viable. So what types of feedstock are likely to drive future growth and how can they be unlocked? And this one is also for Mia and Auntie Mikhail. So could we start with Mia, please?
Sure. So I think today the most widely acceptable and commercially viable SAF feedstock waste lipids, primarily the used cooking oil and also certain categories of waste animal fats. They are well understood by regulators and they are also proven in the commercial HEFA plants and also face fewer sustainability concerns than the crop-based oils, which give investors also and off-takers a high level of comfort. However, just relying on just used cooking oil alone will quickly hit the limits, especially as as I mentioned earlier, the biodiesel co-processing, and also even animal feeds compete for the same pool of supply. So the next wave of growth has to come from a broader basket of waste and residue feedstocks. In Asia Pacific, that includes other waste-based materials, broader biomass residues, and also non-food waste streams. But however, to unlock these resources will require three things. So again, clear science-based sustainability criteria, so new feedstock can be recognized and certified. Investment in the ground infrastructure, collection, pre-processing, and logistics to turn the fragmented streams into a bankable scale. Then next would be the stable long-term demand signals from airlines and fuel suppliers to justify for the capex. So used cooking oil and animal fats are just the workhorses today, but diversified waste and residue-based feedstocks in Asia Pacific will be critical for tomorrow. Thank you.
Thank you. Then Auntie Mikhail, would you like to add to that?
Yeah, many of the essentials came there already, but yeah, indeed, to go beyond UCO and other HEFA feedstocks, of course, when it comes to other technologies like alcohol to jet, many people say is the next in line. So there you can, of course, have the, let's say, first G feedstocks like sugar and starch crops, and you can have the 2G feedstocks, agricultural and forestry residues. I think there is good to be smart also with the 1G feedstocks if they, for example, meet the CORSIA sustainability framework and comply as CORSIA eligible fuels. I think they are a good option. And then I think one thing to note is that if the developers build their ATJ plants, maybe it's easier also to start with easier feedstocks and then transition into harder to process feedstocks after the companies have learned how to operate the pre-treatment and the facilities. I think this is also something that was done with the HEFA production, that the company started with a bit cleaner feedstocks and then started to add more and more difficult ones. But yeah, then of course it's a bunch of technologies that are needed. Also the ESAF feedstocks, and all of these need investments, of course, to the supply chain to collect and process these feedstocks, and it's going to look different for different countries. So in the APAC region, we have countries like China, Malaysia, Indonesia. There's so much biomass feedstock potential. We have countries like Australia. There's a lot of renewable electricity potential. And then, what would I say? Maybe countries like Singapore and South Korea have less, for example, biomass feedstock availability, and really need to think about the partnerships and efficient trade flows to make it all work.
I definitely agree with that. I think collaboration is definitely what this market needs right now. So let's sort of move away from the supply side of things and move on to the demand side. So my next question is for James and Czech. Who are your biggest buyers, and will the primary buyers of SAF remain airlines, or are we going to see other, like maybe tech giants also joining in? Could we start with Czech, please?
Sure. Our insetting program, we started this product called Go Green Plus in 2023, February of 2023. So the idea was to allow our customers to really participate and lower their Scope 3 emissions by just buying this SAF through us. Now, I think during this very short period of time, I mean, it's just been slightly over 3 years, we've seen really, really strong uptake. Now, the interesting thing about the uptake of the customer segments, I can share a little bit of insight, because at the beginning, we were expecting MNCs to really, jump in on this product. But the uptake was really from the SMEs and individuals. So today, we see penetration highest among SMEs. among the big multinationals, we see the banks, technology customers, right, consumer, life science. These industries have embraced the carbon insetting program. I think the rest of the MNCs are a little bit still reluctant. And I can see a long decision-making process for them because, in an MNC, the logistics cost center is different from the, ESG cost center. And so the decision authority, the approval authorities are unclear. They need real global direction to unify everyone to pull in the same direction. One thing I've observed though is we, DHL, in our booking screen for your shipment, we added a tick box so that if you are, shipping on behalf of your company and you want to inset for your particular shipment, you can just tick. And we've seen that employees within companies have been choosing this option. What it means is that while the MNC as a whole is reluctant or slow to make the decision to really embrace GGP, but individuals within the organization are already making those kind of decisions. So it's quite consistent because our SMEs, a lot of the SMEs who have embraced this program, really also behave almost like individuals, right? So they don't have a very long decision process. It's really up to the values of the founder or the owner, and they sign contracts with us. And even the retail customers that we have, just walking into our facilities and with a shipment and they want to ship it immediately, they embrace the Go Green Plus product as well. So yeah, so no, I think the answer is probably not intuitive for many people. It clearly wasn't something that we were expecting, but yeah, that's been the way the uptake has been for us. Thank you.
Thank you. And then James.
What? I need to be careful because we're very lucky that we have a number of our customers on this call, and obviously we're very thankful for the business that we do have. What I might talk about is purely from a practical sense. The way that we found our sales pipeline working today is that when it comes to voluntary markets versus obligated markets, still very much in the SAF market. Obligated markets, or at least subsidized markets, are the ones that drive much of the demand, and that shouldn't really come as a surprise. That economically makes a lot of sense. What I would say is that those who do potentially lift within APAC, where they do lift and it's not necessarily covered by, call it a mandate, they will often lift in at least subsidized regions like the US or within Europe or the UK, as that does sort of narrow the green premium, so to speak. I know that this is a SAF focused forum, but another point of that I'd like to make is, as much as SAF is definitely a huge part of our future growth, we very much see the economics of renewable diesel and bio-naphtha for that sort of point being also crucial to ensuring that we're able to continue to deliver SAF at a competitive price point. And that, at least from a heifer perspective, is actually quite key, as we still, even at full utilization, will still produce quite a bit of renewable diesel. And so on that point, this is something that when any economy or framework is looking at the future of their low carbon liquid fuels industry, it's something to take into consideration, that you will need homes inevitably for both. But yeah, that's it from me. Thank you.
Thank you. Could you both perhaps share a little bit about how you attract your customers to pay for the green premium? Because I think we can all agree that SAF is definitely a lot more expensive than traditional jet fuel. So I understand that the main hesitation is perhaps the price. So how do you attract these customers?
I think you're right. The main hesitation is really the price. A lot of times, my customers started just by understanding the very obvious cost component of it. But one of the, like I said, the SMEs, they make decisions fairly quickly. So to activate the SME customer segment, what we've had to do was really build awareness. And building awareness is really educating the sales force, making sure we have forums to explain our product and how they can benefit. One of the feedback that I've gotten from those forums and those interactions was that the reporting tools that we provided with the SAF was very interesting, because a lot of my customers today are at the point where they are still thinking about how to report, and using our reporting tool that formed the basis for them to start reporting. They're making their own reports. So our reports, our certifications, those things have been very useful in the adoption of the SAF fuel product to our SMEs in Asia Pacific. Thank you.
Thank you. So more like helping your customers with dealing with administrative tasks. That seems to help. James, do you have anything to add to that?
Yeah. So how do we approach your customers? Generally, it's a long-term venture. There was a recent study that Sydney Airport actually spoke about at a recent forum, and they mentioned how half the battle in terms of their customer base or passengers was actually just sort of informing them of the fact that SAF, or sustainable aviation fuel, exists. And once they sort of were aware of that product, I think they said that they had about a 60+% favorability sort of feedback. And not to make it too basic, but that often is half the battle. If you go and do what I guess we refer to in Australia as the barbecue test, where you go to a local social function, and if you ask people if they've heard of sustainable aviation fuel, I think you'll find that it's a surprisingly low number. So once you can educate them on that this product actually exists in the first place, I think that is going to be a huge part of growing this potential, or this future industry that we believe in very strongly. Outside of that, it really is about understanding the customer's needs, and as I sort of touched on before, figuring out collectively or collaboratively how best to deliver that product in the most cost-effective place, region, wherever you can sort of get it to them in a way that will allow them to operate a commercial business practically.
All right, thank you. That was very interesting. I think we do have a couple of questions from our audience today. And one of the questions is from James Veal. He asked that, I think the question here is basically, why is the Australian government sort of reluctant towards a mandate, or perhaps the SAF insect funding mechanism? Why are they at best cool towards that? Would anyone like to answer this question, Auntie Mikhail, or perhaps James? I'm not asking you to read minds, of course, but from your perspective, what's your understanding?
Auntie? No? Okay. I'll jump in. Look, I won't pretend to have the sort of federal ministers on speed dial. But in our consultations, what we have sort of had fed back to us is that cost of living is a huge consideration right now, and you're facing from a fiscal perspective sort of a more constrictive budget going forward, and so I guess in some ways concessions have to be made. So I'd say if there's delays or sort of hesitation, as was sort of inferred, I'd say that that's probably playing a factor. We believe that the opportunities for renewable fuels are extremely bullish for Australia, both domestically and how it can be involved in the international market. So, very much our core belief, at least at Neste, is that these are a net positive impact to any economy and will yield, sort of self-sustaining benefits going forward. But it's a long-term journey, unfortunately, and that's just the practical reality of it. But Auntie Mikhail, over to you if you had any further comments.
Well, maybe I'll just add that, James, you mentioned the cost of living issue, and SAF is indeed expensive, and there has been a lot discussion how the mandates in Europe have increased the price of SAF. So maybe that is one of the reasons why the government does not want to implement it, and perhaps they are waiting for at least some supply to come in the country before implementing those, but not much more to say from my side.
Thank you. We have another question from our audience. So at the start, Alfonso stated that in the short term, there was overcapacity of HEFA and SAF, and that it was a long play, but then DHL and also perhaps from Mia EcoSeriers, you both stated sort of shortage on both sides. So there seems to be a lag between the demand and supply. So I'm wondering if you guys have any comments on this. Why is this the situation? Mia, would you like to?
Maybe just to clarify, the shortage that we was referring to was more on the used cooking oil for the feedstock for the SAF and not the products.
Okay.
Yeah.
So there seems to be an oversupply of other types of feedstock.
No, I think most important is I think the market needs to broaden the acceptance of the feedstock types.
Okay, that makes sense. And then check.
Yeah, for DHL, we are doing like 10% blend right now. Our target is by 2030 to do a 30% blend at a minimum. Now, one of the panelists speakers earlier on today said that there seems to be a convergence on 2030, where everybody seems to have this target for 2030. So we're anticipating shortages towards 2030, right? The other factor that could help to answer, I don't know very clearly about Alfonso's point, but DHL, we are in 220 countries. So as a result, we actually uplift a lot of SAF. We want to uplift SAF fuel in many more countries than we are able to. In Asia Pacific, for example, we only got supply in 3 countries. We'd like more, so we're looking for more sources at the same time. Yeah, thank you.
Thank you. So I'm just trying to keep track of time here, and I think we're running pretty low on time now. So I'm going to ask one last question and bring this webinar to an end. One last question for all of you. Could you describe perhaps in one sentence, what is a development that you would like to see in the next 12 months? So could we please start with Auntie Mikkel?
All right. Well, obviously, I would like to see heaps of affordable SAF for everybody, but one can only do so much in 12 months. So to get us on that path, I did prepare a sentence, which I need to read from my notes. So for APAC, I would like to see decisions to use the CORSIA sustainability framework to unlock the region's feedstock potential, combined with well-sequenced policies that start with ensuring that affordable supply exists, and enable book and claim, and use public procurement to send a demand signal and help projects reach FID. That's it. Thank you.
Thank you. And then Mia?
I'm still going to push for the CORSIA feedstock acceptance, and I also like to see the airlines or the end customers broadening the acceptance of the different feedstocks, especially because we are having this webinar, based in Australia. So I think, we should also consider cover crops like canola oil. So which is also not really accepted by the European airlines today. So so the acceptance of the feedstocks. Yeah.
Thank you. We're hearing a lot of CORSIA mentions today, it seems. All right, Mr. Check, would you like to go next?
I won't mention CORSIA, but say something else. So in DHL, we are very, very involved in trade, as you can imagine, right? So a lot of the trade talks we are consulted on, and many times, whether it's the ASEAN forums or the APEC corporations, the discussion recently has been very, very overshadowed, I think, by the trade flows, because of all the things that's happening between China and the US, and the situation in the Middle East. I would like to see a re-emergence of discussions about ESG, and in particular SAF, in the next 12 months. I think we've taken a pause on it. We should not forget about it. So I'd like to see that getting back onto the agendas of those discussions again. Thank you.
Thank you. And then James?
so much has been said already quite well. I'd go back to this idea of incremental progress, and I think it's already been also well trodden by some of our other panelists. But the problem that we have ahead of us. So there was questions about, are we in an oversupply of SAF? Are we in an undersupply? So it really does come back to timing. In the spot market, as Alfonso touched on, there's actually plenty of SAF around today. But if we fast forward to some of these very aggressive and ambitious targets by 2030, the global jet kerosene market today, I would put it at about 350 to 370 million metric tons of jet kerosene. So, not that these 10% targets affect all of that, but let's, for a second pretend that it did. That is, substantially more than 30 million tons of SAF that needs to be produced. And today we're practically talking about a run rate of about 2.4 million metric tons of SAF that are happening in a sort of globally in a single year for 2026. So there's quite a big gap. And I think having incremental interim targets will help. And it's really about this progress, because the downside risk is that we approach 2030, it looks like it's practically infeasible, which it may be, and then these targets get moved, and those companies, like many of our panelists and speakers today, which have made these investments, sort of find that the legislation that they've made these investments under has changed. So incremental progress, interim targets, and a pragmatic view that this will take time, but by stepping it forward, we can get there.
Thank you very much. It's all about the small steps, one step at a time. All right. It seems like we all have pretty fabulous outlooks, and honestly, I don't doubt that these will all become realities in time, especially keeping in mind that 2030 is coming near, and we're all very invested in this industry. So with that, I will bring this webinar to an end. This was a great conversation, and I really enjoyed discussions with all of you. I hope that you all had the same experience, and hopefully you have a better grasp of this market. Thank you to all the speakers again for attending this event, and thank you everyone for listening and engaging with us. Once again, Leader Associates is hosting this year's SAF APAC Summit in Melbourne next month on the 8th and 9th, and we hope to see everyone there at the summit. And I hope you all have a wonderful rest of your week. Thank you very much. All right.
Thank you.
Thank you.
Thank you all.